how I find undervalued properties for my clients, for myself, and for anybody who wants to do uplift. Now, the reason that it's so important is, let's face it, with the interest rate being where it is, if you're doing 100% finance, as in you're drawing down the equity from your residential property or your commercial property to buy again, or simply that you've got money parked in your offset and you're taking that money out, there's a cost to that, and it's really hard to break even. You're going to be in negative territory in residential, but also slightly in commercial as well. So the only way to really beat the market is to actually find more uplift properties that are undervalued. So what exactly is an uplift? How you find value add properties? These are the three things that I look at when I'm looking for those undervalued properties, and I'm going to give you a final tip to really help you accelerate and understand what makes a deal work. So tune in all the way to the end of the video so I can give you that full tip and you can really action it right now in this current market. So let's get started. When we're looking at undervalue, what exactly is undervalue? Undervalue is when a property which ordinarily might be sold or bought for $1 million is being sold for, let's say, $800,000. Now, why is it being sold for $800,000? A lot of people think, well, what's wrong with that property? Is it the property that's wrong? Or is it that it's something that's creating the undervaluedness of it? Can I fix that problem and make $200,000 from it rather than thinking it's all too hard and walking away from it? Because that $200,000 equates to somewhere around 20% gain, which will allow you to buy again so much sooner. Doing it right means that you can get into the next property within 6 to 9 months of buying your first property. That's why creating uplift is one of the fundamental and most important strategies in any property, but most importantly in commercial property, because right now you can do it faster in commercial property than in residential property. So we already know that undervalue is where you can buy a property for much less than what is really worth in this market. And then what exactly is uplift? Uplift is when you actually realize the value gain you've added to this property. So a lot of people in residential call it manufactured equity. Doing your small renovations, your granny flats, your extensions adds to the value of the property. In commercial, it's changing the tenants, doing a new fit out, getting new leases, and creating or meeting the demand of the market. So the uplift comes in changing the new tenant, getting a new lease, or better, taking care or refurbishing the property. So it's fundamentally different from residential to commercial, but the concept is the same. Creating the uplift, meaning that it gives you the additional leverage for you to go and buy again, because that additional leverage means you can refinance against it, pull the money out and do it again. But at the same time, you're getting an increase in rents, in cash flow, increase in security, and increase in the quality of the property. So those things make it super important for you to hold it for the long term or even to sell it to an investor. So now we know what undervalue is, what uplift is. Let's go into the 3 pillars that you need to know in order to find an uplift property. Now, the number one thing I look at is gentrification. Has this area changed in the last 10, 5 to 12 months? So what do I mean by gentrification? It actually means that the area is getting fancier. So when it means it gets fancier, it means that once it was maybe a really heavy industrial area where we have 1,000, 2,000 or 10,000 square meters of land, and we have a 3,000 square meter warehouse or a 1,000 square meter warehouse on it, lots of trucks, lots of your B doubles, and just very heavy manufacturer industry there. Now over time, as the residential pushes out, our urban sprawl pushes out, what we're going to find, people don't like heavy industry next to their residential houses. They don't like the grinding, they don't like the traffic, they don't like the noise of it. So what happens is the council goes in, rezones the area, tries to push these heavy industries out, and what comes in is medium and light industry. Now, medium and light industry means that the value of land had actually gone up. Now, with the value of the land going up, it means that the prices of these land, warehouses, the rents, they all start to go up. This is gentrification. So what really happens, we've gone from all the trucks and everything else to now having your service trade tenants. So that could be your mechanic, that can be, let's say, your dance studio that's in little warehouses, that could even be your play centers, that could be your gyms. So it becomes a little bit more trade, but a little bit more retail, right? And then of course the area changed even more as more and more people come into this area. Now they're going to push out and get rid of warehouse industrial altogether, and what they're going to bring in is more your retail, office spaces and high rises. At that point, you would find the value of the land and rent have tripled or sometimes even quadrupled or 10 times, depending on how fast it's happened, from when it used to be a heavy impact, big industrial land to now that it is in an office in a high rise, right? And that's really the definition of gentrification. The area gets fancier, the tenants change. You've gone from a heavy industry tenant to now a white collar, potentially a lawyer's office or an accountant's office who's paying premium rents, right? You might have brand name tenants downstairs in your retail, they're paying top notch prime premium rents. And that's gentrification. That's one of the key things I look at, is how has the areas changed? How has the value changed? How has the perception of the market and the demographics of the people that live in this area has changed over time to keep the value up and continue to grow? So that's the number one thing. Number two is I look at short leases. Why do I look at short leases? I look at short leases and I know that you can't do an uplift while you want security. So if you are looking for security as in 5, 10, 15-year leases, tenants been there for 20 years and haven't moved, that is not an uplift property. That is your set and forget anchor investment properties. And if you want that type of property, I've got a separate video all about how to invest in those type of properties, those set and forget properties, and a heap of other tips in my channel about it, so do check that out. But the main thing is, if you're looking for uplift, you can't have security with your uplift. There's going to be an element of risk, and that risk comes in the form of short leases. The temporarity of the short leases means that your tenant could go in 12 months time, 18 months time, or even in 30 or 60 days. But when they go, you have a chance to change the property to meet the current market needs. So let's think about this. If, for example, you have a tenant that is a trade tenant that has been doing a lot of manufacturing, but now there's a demand for more trade base, as in just your simple mechanics, people selling car parts, or maybe they just want a e-commerce tenant that does B2C, as in business to consumer, to pick up goods, or to be actually shipping it all around Australia. So at the moment, you have a current tenant that's there that doesn't fit the purpose of it, and they're not paying that rent. Let's say that the new tenants in the area are paying $300 a square meter. Your tenant might be paying $150, $200 a square meter, and they're on a short lease. When that lease comes up in 12 months time or 6 months time or 18 months or whatever time it is, you go back to the tenant and you say to the tenant, hey, Mr. Tenant, guess what? The rent now in this area is $300 a square meter. Your rent is at $150 or $200 a square meter. If you want to stay in this premise, you need to pay $300 a square meter. Now, that tenant may not be able to afford $300 a square meter simply because his business margins does not allow him to pay $300 a square meter. So he'll have to move out. Now, that's going to leave you a bit of a gap where you're going to need to have a buffer. So when you do an uplift project, one of the things you need to know is you need to have a defined pile of cash. And if you join us for one of our events on Uplift, a part of the Unikorn community, we're going to tell you how much that pile of cash you're going to need and what the formula is going to be to be able to do an uplift deal successfully. Now, my name is Helen Tarrant. I help everyday Australians become wealthy and retire with passive income through commercial property. If you want to find out more, you want a team to help you, and you want to get to financial freedom faster and earn your passive income, then you need to click the link below, book in a strategy call with us, and let Unikorn show you how you can get there in the next 3, 5, and 7 years with a defined plan. Now, coming back to this. So let's say your tenant can't pay $300 a square meter. They're going to move out. You're going to want new tenants. Now, you might have a really big property. Now, the property might be really suited for this current tenant that's there, but the area has changed, so the tenant will have to move out. But for the new tenants, they might want half the space. So let's say you have a 300 square meter warehouse space or an office space or retail space. Now, the new tenants, the new trends are going to be 150 square meters. So you're going to have to find a way to divide that up and bring in the new tenant. But because you're doing a whole refurbishment that maybe you need to repaint, gyprock, new power sources, check your plumbing, get the fire compliances done, and you need to put air conditioning and just redo the flooring and the the drop ceilings, everything. Like, you're going to spend some money on it. But when your tenant comes in, because it's a brand new tenant and everyone's paying $300 a square meter, you could be charging $330 a square meter. Because, again, when an area gentrifies, all the rents are going up over time. And when you have a brand new refurbished premise, you can now charge slightly higher. And typically that's 10 or 15% higher. And people still want to come in because it's a brand new refurbished premise that suits the demand of the area. So that's one of the things that's really important when you're looking at uplift, is how much you can go from this current tenant to the next tenant. Because let's face it, who cares if your tenant leaves if the next tenant is going to pay you more rent? So that covers off two of our points. One, about checking the area for gentrification. Two, finding short leases in the area, so when the tenant leaves, you can bring in new tenants that's going to be paying more for the property. Number three is making sure that the market and the current tenant rent is under market compared to the market. So look at the market rent. If the market rent is $300, now what most people make the mistake in is they see a tenant in the general area that's paying $300 a square meter, and they go, that's what the new market rent is. My tenant's paying $200 a square meter, so they're paying under market rent. No, that's where most people get it wrong. What you need to do is go and research 10, 12, 15 tenants that are in different industries, looking at different types of rents, as in, is medical rent paying $600 a square meter, because medical always pay above the market? Is government rent paying $400 a square meter because they pay a little bit above the market? Is typical rent by, let's say, a vet tenant, a cafe, let's say martial arts studio or a dance studio, $300 a square meter? You need to find the comparisons of all of these rents so you get an understanding of where the scale of rents go. Then you need to look back at your tenants and compare that tenant to other like tenants that's a little bit further out in the area. So they're saying, oh, this current tenant might be, let's say, they might be a mechanic, but they might be a mechanic that serves buses. Let's say a mechanic that serves buses and they're paying $200 a square meter. All right, maybe 10 kilometers away in other suburbs, other bus companies are paying $200 a square meter, or $220 a square meter, or $150 a square meter. What you're trying to define is that they're paying truly under market rent, or are they paying market rent comparison to what everybody else is happening in the market? So the reason you want to do that is because you want to get a true clarity of the range of rents you could charge for different tenants. You want to know that this tenant is definitely paying under market rent, so that they don't come back to you when you come to rent negotiations and goes, actually, you know what? My uncle, my father's brother and son is also running a bus business and they're paying $200 a square meter or $180 a square meter, and then next suburb out, right? You need to make sure you have some evidence, right? That comes from due diligence and a lot of research. And that's why when you do an uplift project, we help our clients really hands-on to find that research, because that research is fundamental to making it successful and getting a 20 to 40% uplift, right? So once you've defined that rent definition is really key to you understanding and making it work. And if that metrics doesn't work, you're going to have to dump it and look at another property again, right? In a ratio, how to find an uplift property, in reality, we might look at 100 properties and one of them will fit. Because a lot of things out there get put through by agents as value add, uplift, but in true reality, the agents don't actually know what exactly is a value add. I always say a coffee cart on a premise is not a true value add. So when you've done now those three things, look at gentrification, the area changing, look at the short leases, that gives you the opportunity that the new tenant's coming in is going to pay more rent. You've done number three, your rental market appraisals, as in your rent research that is paying lower rent and the scale of rents. Now you're ready to define what the value of that property is. Once you've got those three elements defined, you can go ahead and be certain that when you do the deal, you are going to get the uplift. Now you make your offer, you go and do your further due diligence on the building, on other tenants that might be suitable for your property, and you're ready to go, right? Now, I'm going to share with you this example of what it is. So this property here is in Woolloongabba. Now, Woolloongabba is 3 km from Brisbane CBD. Now, from Brisbane CBD, Wollongabba is also part of the Olympic precinct. Now, part of the Olympic precinct means that later on there's going to be more influx of people. There's going to be a shoot up in terms of the demand and the rents that's come up in the next 7 to 9 years as the Olympic approaches. Now, one of the key things I really love about this property is that it is a freestanding corner block. Now, that is a residential term. Whether it is a corner block or not, it doesn't really matter. But what I'm looking at is access. It actually has 3 rows access, which means you can put 3 different tenants in it. You can divide it into 3, right? Now, obviously, we're going to need to make sure the logistics work, having the 3 tenants. There might be some rejigging internally of the property to make sure it really flows for all the tenants, but it does have 15 car spaces, and there's availability to park further down the road as well for the tenants coming in and out. So you can have a variety of different tenants. The other thing I really like about it is that it's not affected by flood, and which means it opens itself up to a huge range of different kinds of tenants that would go in. Plus, on top of that, you can do retail, you can do office, and maybe you could refurbish one of the properties into a little warehouse. So because the area is zoned light impact industrial, you have the versatility of being able to accommodate for all of these tenants. So this is a prime example. When I look at this property, I know the area is gentrifying because Wollongabba has come a long way in the last 10 years. I know that at the moment it's tenanted, but the leases will be coming up in the next 2 years. I know that at the moment the tenant is paying a certain level of rent, and I'm still going to do my research on what they could go up to in rent and what kind of refurbishment this property needs to be able to bring the tenants up to the next level of rent. So this property, when I look at it, just simply as an overall big picture, it fits about 80% of what I'm looking for. Now, it may be out of your price range because to buy this property, we're probably looking at a 3 mil plus to just look at buying this property. So we need to do the metrics and work out if the yield or the returns on the property after we do all the full refurbishment is going to stack up. And now that's what I'm going to do further research. And so look out for my article as I dissect this property later on social media. So again, if this is the type of property you're looking for, do book in for that strategy session. It's absolutely free. To join one of our events, the link is below, because we can share with you how commercial property can get you to the next level so that you can retire sooner with positive cash flow and also sooner with more equity. So this is a classic example in Wollongabba. If you're looking for something, you can take the points that I've given you in this example, in this video, and go and find something on your own. But thank you for staying to the end of the video, and I'm going to share with you the final tip that's going to pull all of these together. And that final tip is demand and supply. Demand in the area is fundamental. Now, commercial property is not at the mercy of the market of interest rates. So the interest rate could be at 10% and commercial property still can be trading at 2%. It doesn't really matter if there is demand in the area. And that's the most important thing that will pull all of your theories together and all of your concepts together to find a property is the demand. You got to look at, is there demand for this type of property? So let's say the area is all industrial and you're the first office space and retail. You're going to struggle finding a tenant. Doesn't mean it won't be, but you're going to know that that rent is not going to crank up to its maximum level, potentially for another 3 or 5 years until the area changes more into that office and retail. However, if you're not the first person to create a retail office space in an industrial area, you might be the 3rd or 4th or 10th, then you know the market's already been defined. When you're trying to define a market, that's when you take the hit the most. But later on, when the market's defined and you're just going in to reap the rewards of it, that's where you're going to get your maximum uplift. So check out the area, make sure there's that demand. If there's no demand, then maybe that property is not right for you right now in this area. Maybe in 3 years' time, that property will be right. Unless you want a land bank for 3 years, that may not be the right approach to you. So you got to consider the demand. So the demand is there tenants that want to come in and rent my premise if I do it up to the standards of the market? So if I do a massive, great fit out, is there a tenant that's willing to come in and pay me $500 a square meter, even though the other tenants around the area are paying $300 a square meter or $400 a square meter? But my building is going to be brand new, refurbished, and it's going to suit a tenant walking off the street and start operating the business. You got to ask yourself that, right? So finally, when we look at those 3 points, remember gentrification, short leases, defining market rent and low market rent, And finally, at the final point of demand and supply. Is there that demand in this area? Can you supply to it? Is the demand still to come, or is the demand already established? If you can find a property that fits into those 4 elements, then you're a great way to getting started to do your first uplift project. My name is Helen Tarrant. I help everyday Australians become wealthy and retire sooner through commercial property. Click the link below to book in for that free strategy call. I hope you enjoyed this video. Comment, do share with me what you're thinking about uplifts and how you can get ahead in the commercial or any property space. Until next time, keep hunting, keep looking for that property, and make sure you subscribe, hit the bell, and pass this on to all of your friends who want to retire sooner. Thank you very much, and I'll see you in the next video. Bye for now.